Yeah. So first question comes from Yami. He asked the market outlook for gold, as well as the US, German, and Japan indexes.
Oh, the $1 million question. I mean, if we knew what the future would hold, then we'd just trade that and make heaps of money. But of course, we don't really know what's going to happen. There's sort of all the Ukraine thing, there's inflation, there's interest rates being risen. So there's certainly a lot happening. But who knows what that means? I mean, I think I heard on the news tonight that there's been, at least on the Australian market, about a 50% recovery from the drop earlier this year. So we've had a bit of a rally that we've taken some nice chunks out of. Whether that rally continues, who knows? We might see more periods of sharp drops and then sort of a more steady rebound. But what our systems want to look for, short-term breakouts. So a drop isn't particularly bad for us as long as it's like a nice solid drop. We will see when we see the rebound, our systems should take good advantage of those rebounds as they break the previous highs. So yeah, the answer is who knows.
Yeah. Next one also from Yami. Notice there haven't been any shorts for the past couple months. Has the system been converted to longs only?
Yes, we did have some shorts. What was happening with them was they were set up to basically lose a little bit of money all the time, and then cash in on the big drops. So as is the way in trading, often just as you turn something off, you get the big drop. That doesn't really make the decision wrong. What we were finding though was that, especially early on in our history, the appetite for those losses on the short systems wasn't particularly there. So it was a bit disheartening to see the short system sort of enter and lose and enter and lose. I know you kind of meant to have a long-term look at these things and put up with them, but yeah, we decided that just at this moment we didn't like how the shorts are running. We will have another look at getting some short systems because, as we've said previously, we've improved our development process. But right at this moment, we took shorts off because we just wanted to improve everything. We thought that the shorts weren't quite as good as we'd like them to be.
Next one also from Yami. Time frame or estimated time of arrival for any new asset class the systems will be trading?
Yeah, well, the first one that we're going to see is gold. We're in the final stages of balancing the different systems. As you add on more systems, you have to make sure that not only are they not correlated with each other, but they're not correlated with the previous systems that we have. And then we've got to make sure that all the different systems that make up the new gold portfolio all have their risk management correctly, and that people can trade them with the correct risk management on sort of accounts of about $5,000. So when we're looking for our risk balance, sort of the minimum amount that we are looking for people to have is $5,000. You can trade it on less, but you're going to be trading just at a higher risk. But back to answer the question, gold is coming up very shortly. So anyone that's a subscriber will get whatever it is that they bought at the time into the future. So at the moment, all the systems are in the one package. So if you become a client now, then you will continue to get all the systems into the future in that package. But at some point in the future, rather than sort of increasing the price sort of 500, 750, 1,000, we might find that we keep the indexes at 500, and then if you want, say, the gold, then you pay another 200 for the gold. But if you buy now, you're getting the whole thing for the life of your subscription. Then after that, who knows? It could be gold. We will be revisiting the shorts. We've got Currencies, but as people who have been with us a while know, that we don't really rush things. We want to make sure we get it right, because you're a long time busted.
Okay, perfect. The next one comes from chat. Apart from having successful portfolios and a track record within, any particular learning/processes you're willing to share in best practices starting a trading enterprise?
Realistic expectations, I guess. Like, you can try and start your trading enterprise as a flash in the pan and look to sell as many copies of your system as you can, promising people 25% per month returns. And then if you can manage to get it for a few months and make a few months sales, you can probably make a pretty penny in that short amount of time. Over the course of history, there's been multiple people who just are sort of serial EA sellers, and they'll sell an EA that works for a couple of months, or hype up a back test of the latest system, and then it'll go bust, and then they'll just repeat the process. So you can do it that way, or you can do it the proper way, and get something that is going to return 40 to 60% is probably a good aiming point per annum for our kind of where we are in the market. Because what we're looking to do is, over the course of the next 2 years, build up our trading history, and hopefully gather more and more interest. And as the history gets longer, more and more serious interest comes along. So that's why our prices keep going up, because as we evidence ourselves with our history, we charge more. And eventually the ultimate aim would be to manage money. But that's not going to happen for sort of another 2 years or so. So in the meantime, that's why we're offering it for sort of a few $100s a year, is because we haven't got the long-term history that actual fund management does have. So yeah, make sure you're looking long-term. Worry about the losses. So especially when you get trading serious money, like in my other sort of project, we trade some proper money, and people are always more worried about the losses than they are about the profits. Because if they're going to invest sort of tens of thousands, hundreds of thousands with you, they want to know that you're not going to lose it all on them. So anything sort of over 20% return in a year, they're delighted with. But what they don't want to see is losses sort of more than 10 or 12%. So yeah, I think long-term, risk-averse strategies is what will see you be successful, and not sort of a fly-by-night thing.
Perfect. This one comes from Yami again. He's asking, how scalable is the system for high balance accounts?
Quite scalable. What we find is that different brokers use different liquidity providers. So Global Prime have their set of liquidity providers. Dukas Copy is almost its own liquidity provider. Pepperstone would have another set. So as we're sort of, people are using all the different brokers, they generally passed across all the different liquidity providers. And the way that our trades work, we're not looking for sort of small movements and trading large lot sizes. We're holding for quite a number of hours or days at a time. So our lot sizes aren't particularly big. We would have to have quite a substantial client pool to be starting to run into liquidity problems. We've got people at the brokers who are monitoring the amount of liquidity in the markets when we're trading, and we're nowhere near sort of even causing any problems. with that. And if we do get to the stage where we're trading an absolutely obscene amount of money, or that kind of thing occurs, we can actually go across to the futures market and just recode our systems onto there as well. So like always, there's challenges, but if we get to the point where we're all trading that much money on these systems that we're running into liquidity problems, then it's a good problem to have.
Yeah. Next one from Yami. Will you guys continue with weekend holdouts in the near term?
Well, yes. Basically, all these models are built without sort of a close on a Friday thing. They all hold their trades over the weekend. A few weeks ago, the whole Russia war was kicking off in Ukraine, and there was the old buy the rumor, sell the fact. So in the lead up to the war, the market had taken a fair dive, and then when the war had just started, sort of midweek, the market actually rallied, and then on Friday afternoon, because the war was very fresh and it was still uncertain as to how much resistance Ukraine was going to have and what effect that was going to have on the markets, and there was talk of all the economic sanctions, etc., etc., and the profits were there, quite good ones to be taken. We took them, but now the war's sort of settled into sort of a longer term situation. The political sanctions have sort of calmed down a bit, so we don't see any particular need to be closing on the weekend. But of course, if it seems like something is becoming quite dynamic, or there's peace talks or something, we might do that. Although peace talks, you would imagine, would bring the market up, but the markets do funny things sometimes. So I guess the short answer is no, unless, yes, there is a reason, a solid reason.
Yeah. Yami asked again, not sure if the system already does this, but does it open trades if the initial trade was missed for whatever reason and the price is better than what it was at the original signal?
No, we actually have it set to not trade that way. I actually can't remember if there was an actual reason for it. Because we have it set that way, I'm thinking that we might have. But that reason could just be because we're really conservative and we just don't want sort of strange things happening with people's accounts. But yes, if your system isn't connected at the point that the trade is taken within sort of I can't remember the exact timeout. It's something like 30 seconds. Then the trade will be passed by for you, and that mainly is just to ensure that nothing untoward happens, so that everybody's account is as safe as possible. Because we would much rather people miss trades than got multiple trades or erroneous trades. Because if something goes wrong and multiple trades are open, we could crash someone's account, and that's just not what we want to do. So the whole trading system is set up with multiple fail safes and to be as safe as possible to run. So sometimes that means that that things like missing trades, if the system isn't up at that particular point in time, something that occurs. But while we'll always look at making things better, we also don't apologize and won't risk bad things happening to people's accounts.
Yeah, and again, next one from Yami. Will there be a possibility in the future of a risk setting midway between that we have now on the normal and 2 times, for example?
Everything's possible. We set it up to be simple because we didn't want people to be able to run the system too high. Like previously when I'd made retail EAs, we had some people just run the risk at stupid amounts and then crash their accounts. And then you end up with accounts on MyFX book and stuff that go to 0% with your system's name on it. And that's just not good. And it's not what we did. So when we set the risk management up, we basically restricted people from doing too much stupid stuff. But in doing that, we also took a lot of autonomy away from people. So maybe in the future we can look at giving more options for the risk management. It won't be happening next week because we've got the gold thing that we're working on at the moment. But you never know in the future.
And Yami also asks, is there any possibility for currencies in the future?
Oh, definitely. Big possibilities. We started off sort of looking at currencies, but then decided that we'd go to the indexes and the other things just because they were less done in the MT4 world, and we just wanted to be a little bit different. And I guess that comes out as well in our silly naming. But yes, we will get to currencies. But these things are a slow burn as we get each thing right before we send it on to people. Like I think the gold system now is probably coming up to close to 6 months of testing. We've gone through various stages of improvement in the development process. So it's not something that we just do 1 minute and throw on the next. So yes, we're getting to them, but like everything, we do it properly, and sometimes that just means a bit of patience.
Yeah, and Yemi saw the podcast video that you did with Global Prime with Ernest P. Chan, and he was wondering if there's any more podcasts that we can expect from the hippos in the future.
Yeah, well, this is the start of them. We're going to do some weekly ones. So any questions and that kind of thing, we'll start off with that and we'll see where it goes. But yeah, if you want to see me on other podcasts, feel free, if you know of any, to let them know that that I'm around, because I'd be more than happy to talk to anyone doing a podcast about anything that that I've got some experience in. More than happy to help add to sort of putting a sensible voice, I suppose you'd say, out into the blogosphere, or whatever the kids these days call it.
Yeah, and the next question comes from Gloria. She's considering creating an EA based on a strategy that she thought of, but it will be trading the weekly chart. Do you think it's worth the hassle, or should continue trading manually?
Well, I'm imagining if you're trading a weekly chart, you're looking at long-term setups. So I think the advantage of an automated system on a weekly chart would be much less than on a lower time frame chart. That said, I think what Gloria will want to do is make sure that she's very systematic. So she's got her rules and she sticks to them. I mean, if you're looking at weekly bars and you're looking to hold a trade for a month, for example, sort of four or 5 bars, or 3 to 5 bars, then you can probably check that trade twice a week, and you get in. It's like looking at an hourly chart a couple of times an hour. Yeah, the thing that she'll need to make sure of is that she's got a system so that she sticks to it. So the exits happen when the rules say that the exits should occur. The entries happen only when the rules say. So that if she can become the computer, then there's no real reason to automate it, unless of course it's easy, and then you can automate it and put it across all the different charts. You don't have to look at them yourself. And it depends on the system. Some systems could be easy to automate, other systems could be quite complex depending on what they actually are. So there's a whole heap of factors, but the slower the market's moving, the less advantage that there is from automation. But just because it's not automated doesn't mean that it shouldn't be very systematic.
And the next one comes from Gearbox. In the most recent drawdown, how did you guys quickly identify the strats and turn them off that were causing the problem? Especially when he assumes no single strat was near historic drawdown and the portfolio as a whole wasn't near historic drawdown. What triggered you and made you think those particular strats were a problem?
Yep, and I think as well someone else asked a similar question about what the hell went wrong in that drawdown. So we might as well start with that bit, and then we'll go back to what happened. So I don't actually think there was too much news happening. It was the sort of November coming up to the end of the year, and the markets just were a little bit messy. There was lots of false breakouts. So this year we saw a drop, then a steady rise back up after the drop. In November, we were seeing sort of false breakouts where it would just break the previous high and then wouldn't have enough energy in it and then would reverse. And so we got caught multiple times on false breakouts where it looked like it was going to break into a new high section of the market, and then it'd fail, and then we had the shorts, and then it'd drop below the current market, and then the shorts would trigger, and then it wouldn't break down. And so we just effectively got chopped out by not having enough buffer between the top of the market and where we were entering. So we could see that happening, and correct, we didn't hit maximum historical drawdowns, either as the collective system or individually. I think maybe one or two systems. We did an analysis that we posted that I think showed perhaps one system did get close to its historical drawdown, but then others didn't have a drawdown at all. And we actually kept those systems, but the systems that had a bigger drawdown, we looked at them and how they traded, and they were the ones getting particularly chopped up. So we went back to our development process and we made sure that when we were looking for these breakouts, that they were real breakouts. So we just made it harder for a breakout to occur. So the effect that had was it reduced the amount of trades a little bit. It decreased the drawdown over the history, and it also decreased the profits because there was less trades. But overall, there was much less length of period of drawdown and smaller depth of drawdown. And then when we visually tested them in these choppy markets, they weren't coming in and getting chopped up. So while we've given away, so if this here is where the market's at, and when we won't enter until sort of a fair distance now above the market, we're giving away profit that previously we were taking in a trade-off to be a little bit safer that we don't get chopped out. So that's what happened in that period. We knew that we couldn't continue to get chopped out, so we went back. We only had to make a very slight adjustment to our development process. We did the development and we came back, and since then we've been really delighted with how the systems have been performing, and we learnt a whole heap there that we'll be able to put into excellent systems going forward as well.
Yeah. Asked that he read that we sold our development workflow process once. Is that something that we are considering, or like a mentorship thing that we're considering? Because he'd like to know more about that.
Yeah, well, we always get asked questions, and this is sort of part of the reason to do these question and answers, and we've done the our white paper. So we're not adverse to giving out our knowledge. Most of the time, it's quite not general, but non-specific, let's say. So it's quite important, and it's quite valuable information. It's just not very specific. I mean, it's something that we've discussed sort of in an ad hoc fashion about, we could do mentorship, but of course, anytime you try and do something new, you've got the time problem. So at the moment, we do our development, and then we have to upkeep the copy system, marketing, as well as just the other things going on in our lives. So do we have time for mentorship? And then when we can decide how much time we have, is that enough for people? What do people want from it? What can we offer? So I think the best thing would be, if you think that it would be a good thing, then let us know what kind of things you'd like, because if we then know what the kind of things it is that would help, we can then look at those requests and figure out if we've got the time and the ability to make it happen.
Next question comes from Avuero, I believe. He asked Norman, "You are not a fan of positivity about proof. Snake oil is snake oil, right?" And said, "Personally, I only accept constructive criticism from those who have once constructed what they have criticized me for."
Yeah, I don't think English is his first language, so it's slightly uniquely phrased. But what he was getting at there was, I mean, he's talking about he only accepts criticism from people who's successful in the thing that they're criticizing in, and you can't sort of disagree with that point. You only take advice from experts, and one way in this game to figure out if someone's an expert is, can they make money? If they can make money, then they're going to be generally a little bit of an expert. But even more than that is the idea about criticism. I think the most important thing in system development, and not even algos, but just system development, so if you're just creating a rules-based system, which could just be the list of rules that you as a manual trader adhere to, or it could be an algo system. But the most important thing is that the biggest critic of your work is you. You have to disprove your work. You have to try so hard to say, this can't be true. So you get a good equity chart and you think, hang on a second, this is too good. Something has to be wrong. And so you just attack it. Is it curve fit? Has something else gone wrong? Why is this so good? This should not be this good. It shouldn't be this easy to make a line that just goes straight up. And so if you're your biggest critic, then no one else really can criticize you, because what they're doing then is giving you ideas. Like, oftentimes people will take my conversations with them and my questions as an attack. But that's because they haven't themselves been critical enough of their systems. So they might show a system and I'll say, well, what spread are you running? What robustness tests have you run? What, all those kind of things. And I can understand why, because it's the internet and things can be a little bit informal. They take that as being sort of a criticism of their work. Whereas what I want to sort of push them to realize is that unless they try very hard to disprove everything they do, then they're setting themselves up for failure. I mean, we all want a great system. but just wanting something doesn't mean that you're going to get it. When scientists do experiments, what they're setting out to do is disprove a theory. And that's what we have to do when we're running our algos, if we're developing our trading systems. We have to always think, how is this tricking me? Am I doing something here that's giving results better than what they actually are? How can I make this system play on hard? What happens if I increase the spread? What happens if I change the parameters around? What happens if I run it on a different system? You're testing it and you're saying, how can I make this fail? And if you go through all your different tests and all your different ways of trying to make your system fail, and it doesn't fail, then you're sorted.
Almost leading on from that, Jason has asked, what are some examples of robustness tests that we use during the testing phase?
Yeah, well, that's really well covered in our white paper. So it's better to get the white paper because you can read through it multiple times. And the idea of the white paper is not to be a be-all and end-all in-depth look at each of these robustness tests. It's to give a very broad overview, an introduction, if you will, into the importance of robustness tests and what they generally are. And so effectively what they're doing is attempting to make your system fail. So it's saying, was the result that you've gotten, because as you develop, you find a good idea or you find a good result, and then you want to know, was that result I found lucky, or was it due to something that is underlying in the market and is going to keep performing in the same way? And so what you're doing is discounting luck. And so all those different robustness tests do that. So running it on a similar but different market, changing the formation of the bars slightly over time. I wrote the bloody paper, I can't even remember them all. The various Monte Carlo ones where you change the trades around, you skip trades, pardon me, all those kind of things. And then the biggest one of all is your holdout period. So even after all your robustness tests, they're done on period of time that you're using to develop your system, because robustness tests are part of your development. And then your very last and your most important test is this chunk of data that usually is sort of the last 18 months. It's never ever been used. So you've developed your system, you've found line goes up, then you've tested that line using all your robustness systems, and you found that it passes them all. And so what that is telling you is that your system isn't lucky, it's skillful, it's finding something underlying in the market. And then the very, very last thing that you do that proves that your conclusion is correct is you run it on that holdout period that you've never ever run it on. So this whole development process could take you 2 weeks, it could take you a month, it could take you 6 weeks, however long it takes for the development process from the beginning to the end. You come down to this one system right at the end. Then you run it on your holdout period. So in our case, we run it from 2020, 2021, and now 2022. So we have 2.5 years of data that we run it on that it's never seen before. And then if it performs in a very similar fashion over those 2.5, 3 years that it did over the previous 8 to 10 years of development data, then we know that, hey, we've got something here. So it's almost like a pretend demo test. It's like we've gone back in time to the beginning of 2019 and we've put it on a demo account and then fast forwarded time up to the current day, and then we've looked at the result of that demo that's run for 2.5 years. That's what a holdout period gives you, and that's why it's the ultimate test of, does your system work? And it's probably the strongest and most important robustness test to use after all the other ones.
Yeah. Chap asks from chat, apart from Strategy Quant X, what other tools do we use to collate our portfolios?
It's more what custom things we do. So SQX and what's their portfolio?
Quant Analyzer.
Portfolio Analyzer. Yeah. We use both of them because it keeps it in the same family, and we can import SQX files into Portfolio Analyzer. But what you can do in there is code it up and have custom calculations in it. Same as Strategy Quant. So it's like you've got Excel, but then you can create macros and you can create your own spreadsheets. So Excel takes on a life of its own, quite separate from just the boring cells as when you first open up an Excel sheet. Same with SQX. You can go in, you can add variables, you can add statistics, you can add ways of doing tests with those statistics. You can also do the same thing in Quant Analyzer. So when we go into Quant Analyzer, we've coded in custom ways of looking at correlation. So you've got the obvious correlations, like when does it trade? So the times trades, is it in trades at the same time? Then you've got profit and net profit. So does it make a profit at the same time? Which isn't necessarily a bad thing, but if making profit at the same time, it's in a trade at the same time, so it could also be making losses at the same time. Then you've also got the big one that we find quite useful is we custom coded in something that just looks at when it loses. So we can then look at the correlation of all the different trading systems just on their losses. So then we can look at, do these systems lose at the same time? And we actually then, between those different things, we can balance them out. So we can say, well, we give 3 times the amount of weight to make sure the systems don't lose at the same time, the 1 weighting of profit at the same time. So that way then we basically tell the computer what we want. So we're saying to the computer, we don't want to lose at the same time, and we don't really as well want to profit at the same time. It's much prefer not to lose at the same time. So by doing that, and then we can also even pull that back into XQX. So when we're looking at all the different systems we're creating, it's immediately dropping systems correlated. We can then balance our portfolios with things that aren't correlated and make systems that are correlated with what we already have. So effectively, we don't use different tools, we just use the tools we have as effectively as possible. And the people at SQX have made an exceptionally good platform because it allows us to go in and put all these custom things into it. Then it just runs on itself. So it's like Excel doesn't make, or MyOb doesn't give you profitable results is the process, and it's up to you to make the macros and those kind of things that help the software reach its potential.
Chap has asked a follow-up question saying lack of functionality within Quant Analyzer can drive one crazy. Any customization in both products that you've coded you wish to share / highlight with the community?
I mean, it's one of those things that that's what makes us our money, is the clever ideas that we come up with and put in. I mean, it goes back to the mentor thing that we were talking about earlier. So if having access to different tools might be interesting to people, it's something that, not saying yes we will do, but it's something that we could consider. So again, let us know. But what I will say is, oftentimes what we do isn't complicated. What we do is verbs and adverbs like disciplined, thoughtful, conservative. I don't know if I said simple, but simple, clever, non-complex, complicated, reasoned. So don't overcomplicate things. Think about what it is that you're trying to solve, and then think about the simplest way to solve that problem. So if you know a little bit of code and you can mess about with SQX, don't try and overdo it. Do a little step at a time, and don't try and do everything at once. Don't try and create one solution that'll fix all your problems. Find one part of one problem and see if you can make a figure or make a statistic that just informs you about that. So one example is we made a custom thing that we called TipToeHippo. What was it? Stability?
Yeah,
consistency.
I think it was consistency.
It was either consistency or stability. It was one of those two things. But what it was measuring was basically that the line was consistent across the course. So you didn't have something that sort of over the course of time went flat and then went up and then flat, or down, 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 jump, down, 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 or had long periods where it didn't trade. We wanted to see consistent results over time, and so we developed a little formula that looked at each month's returns and drawdowns and judged how consistent they were. And so then we could reject systems that were inconsistent. They had to have some level of consistency. So that's just one example of something that we put in the custom code, and it doesn't even need to be complicated. So you can, this wasn't how it was done, but an idea could be that every month you do a return to drawdown with some function of the amount of trades, and then you give that a value, and then you're looking for that value to be not changing or within two particular bounds, and you'll only accept strategies where that value is within these particular bounds. You don't have to overthink it. Oftentimes, simple ideas executed well are what can solve your problems.
Yeah, there's also a couple of free ones in the Strategy Quant Discord community. There's like returns drawdown per year, and I think profit factor per year, which is similar to what we've done, and it's very useful. And the next question is from Farhan. What type of strategy is important to you? Reverse or trend following or candlestick patterns?
Really, whatever works. I'm not particularly biased. Like my original project is effectively swing trading and momentum trading. That's looking for the sort of 1 to 2 monthly cycles, and then momentum. So it's looking for sort of sharp breakouts. TipToeHippo so far has been looking at, I mean, it's not all breakouts, but the majority of the nice ones we've found have been breakouts. Breakouts and trend following as well. It just so happens that the indexes just by nature tend to trend upwards. So it's more about the process. The process is important. Doing your analysis, building your system logically, making sure that you test your system. There's some videos on our TipToeHippo channel about how to test a system correctly using FX Blue's trading simulator, because it's very important to test them that way. So it doesn't matter what system you're using. Like if you can make what's that thing, the five numbers that heaps of people like,
Guppy?
go on, you know the name of it.
The Guppy one. It's like the 5 EM.
No, well, I've done a video on the, yeah, and I did the video on the Guppy one just to show you how you can think something works until you forward test it. So it's really important that once you've got your system and you think it's good, don't just jump in live. You just spend a weekend with this FX Blue trading simulator, and you'll find out if your system's as good as you believe it is. And remember, like what I said way back at the start, your own most critical person about your system. So really try and break it when you're doing your system. So I know that's, you asked about what sort of style of system's best. Style of system doesn't matter. What you want to do is find a system that works, and it's all the processes around finding that system that works is what's important. Because if you don't use them, you'll either kid yourself into using a system that doesn't work, and then you'll find out when your balance is going down, or you'll just keep running around in circles. So you'll not be analyzing what you're doing correctly, and you'll constantly be putting stuff on forward test that fails because you've curve fit. And while you might be sensible enough not to put real money on it, you're never making that step between thinking you found a good system and confirming that you found a good system.
Yeah, you touched previously on one of your older projects that's still going. I'm sure people would appreciate a bit of insight into the background of some of the hippos.
Yeah, well, I've been doing this game since 2005 and full-time since 2010. Sold some retail systems for 3 or 4 years. Went private then, and then of managing money with that, sort of over time improving our system. Haven't really touched it now for about 5 years. Sort of keeps going on. That's sort of why I've ended up back in the retail sphere, is because it was just sort of running along by itself, and I thought, hey, I can come in and let others know that, hey, it is possible, but it is difficult. Dylan's I met on, I think it was Reddit even.
Is the Discord from the Reddit, yeah?
Yes. I started a Discord answering people's questions rather than on Reddit. I'd say, oh, just find the Discord and I'll answer the question. Dylan had questions, and so did Pot, and so did Goon. So we basically just collected people that asked questions, and then when they were given advice, took that advice and really ran with it, and took it to heart, and did the kind of the process, and they all became successful and could understand that it was the process that gave the good results. I mean, it's just a modern and a small example of the old total trading story, where in the early 80s, late 70s, somewhere around there, two traders on Wall Street had a bet. One bloke said, you're born a good trader. It's a skill. It's an art. Not everyone can be a good trader. And the other bloke said, that's bullshit. I reckon I could get anyone and make them become a good trader. So they had $1 million bet. I think that was the case. Anyway, they had a bet. Sometimes, like Stephen Hawking was famous for making $5 bets and Playboy subscription bets. So the bet wasn't important. But what was that this bloke said, nah, I can make anyone a trader. So he went out and he got a whole heap of just normal people who'd never traded in their lives. And they ended up being hugely successful in one of the top performing funds in the early to mid 80s. Of course, trading's got a lot harder since back then. Even having a candlestick chart was the height of information. Nowadays, anyone with the internet can look up charts. So I think even the BBC did a show 5-ish years ago along the similar lines, where they just got normal people and threw them in front of a computer and got them to trade. I can't remember how that all turned out, but that's how TipToeHippo came about, was people asking me questions, and then out of the hundreds or so who asked the questions, we found a couple that actually listened. So yeah.
Probably one of the biggest tips that in hindsight it was very useful, but we kind of ignored it at the time, was Norman said when me and Grant were attempting to fully automate one of the strategies that we developed about 2 or 3, 4 years ago now at this point. He said, it's easy to automate the first 80-90%, but the final 10% is the hardest bit. So it's the difference between going from semi-automatic, where you kind of get an alert system and then you execute the trade and do the final bit, which saves a whole heap of time. But we were hyper fixated on trying to get that last 10%. So it was completely fully automated, and the amount of time that was wasted on that, and we probably even messed up the whole system trying to do that. I just thought that'd be good little tip. And I don't know if there's anything you want to add to that.
Yeah, because I think even today somebody, I think it was Vicky, shout out Vicky, was asking about a system, and she was saying that she showed it to a program, and the programmer said, whoa, that's like a really complicated system, because oftentimes what the programmers for MT4 are used to doing is taking indicator A, putting a rule in for it, taking indicator B, putting a rule in for it. When indicator A, this occurs, when indicator B occurs this way, then you buy, and then you put in a stop loss, and then you make an exit over here, or whatever it is, but it's based on indicators. Her system was based on sort of chart patterns. So then when she sent it off to the coder was like, well, this isn't what I usually do. So I suggested to her that rather than sort of giving it as just a whole sort of word explanation of how to do the system, to break it down into chunks and say, this is the pattern that I'm looking at, describing it in detail and getting just that bit coded rather than the whole big thing. And then I also suggested to her, because I didn't have time to go through her system with a fine-tooth comb, was to say, well, is it possible to get alerts? I said, oh, well, can you manually trade it? She said, yeah, I could, but I think it was on daily chart. So it's not time intensive, but she wants to use it on almost every market and stocks. And so if you're looking at hundreds of charts, you're going to go crazy. And even on a daily chart, it'll take you a day to get through every chart that you want to look at. So if you've got a system, but it's hard to get fully automated, but it's successful and you've been successful using it, you just want a little bit of help, find out what part it is that you might be able to automate. And it could be something as simple as a volatility filter. So is the market volatile? And you might want a volatile market. So immediately you could have it on 400 stocks and only 80 of them match the volatility that you're looking for. And so you can then just look at those 80. So automation doesn't need to be a nothing or all thing. It can be a little helpful thing just to make your manual trading a bit easier, because some people are just artistic traders and they can just see things in the market that are very difficult to code in. But underlying those things that they're looking at might be some relatively simple underlying factors. Like it could be that they only want to trade in trends. So they can put a simple trend line in that then filters out a whole heap of charts for them to look at. So yeah, just because something can't fully be automated doesn't mean that having a partly automated system can't be useful.
Next question comes from Farron. He said, how do you keep your strategies alive without doing walk forward?
Basically, instead of using walk forward is another one of those robustness tests. And we have experimented with them, and we've done lots of statistics on what are the robustness tests that make a difference. What are the ones that can tell what's lucky and what's not? And we found actually that walk forward systems, at least on the way that we were using them, didn't particularly create systems that were more robust. So it would actually fail a lot of systems that that were robust, and then would let through systems that weren't. Because especially if you're doing walk forward optimization, you're constantly curve fitting to the period of time that has just gone past. So in this period of time here, you've really nailed in your parameters, and then you trade it on this period, and it doesn't particularly go too well because you've actually curve fitted on this time period, and now you're running it on this, and then you optimize this one and then run it on this. And so you're constantly in a process of almost recurve fitting every month. So that's why I'm not the hugest fan of walk forward, using walk forward systems. Like in theory it kind of can work, but in practice what tends to happen is what I just described. You're just sort of doing mini curve fits. So what you're better off doing is looking for something along the whole length of time that is consistently getting results. That doesn't mean that it's a straight line. It means that its ups and downs are generally consistent along the whole period of your testing. And then once that you've got a consistent sort of line that's passed robustness tests, then you can then run it on the data that's never seen, and hopefully it's going relatively consistently up to here, and then it hits the data it's never seen. And even if it's sort of its performance drops off a little bit, which could be expected because it hasn't seen that data before, it's like a live demo test, it still generally performs very similar, then you know you're in a good position.
Yeah, And the next question comes from go in chat. You seem very knowledgeable, Norm. How many years have you been learning and studying trading? Have you ever traded manually, and how do the results compare to algorithm trading?
I started on the markets in 1997 when I was at uni. I worked at a commodity trading company. They took out future contracts on wheat, cotton, wool, beef, and the Australian dollar. So they worked for farmers, and so the farmer would say, "Oh, we've got 1,000,000 bushels of wheat or whatever the fuck the value was that we're expecting to harvest at the end of May." And so these farming companies would have to go off to the banks to get loans to run their farms for the season. So they needed to know what price that they were going to get for their wheat. So we would lock in their price. And then because the price was in US dollars, you would then lock in the Australian dollar value, so that it was creating certainty for their business. They knew what price they were going to get for their wheat in Australian dollars. And then they could go to the banks, get their loans, employ the people, get the farm equipment, etc., etc. So that's how I started. And back then, there was not really such a thing as charts. So my boss had a spreadsheet that he'd been keeping since the 1970s. And one of my jobs was to get a trade magazine and open up the price of the different commodities as they were traded in Chicago and all the different places around the world, and the different qualities of the different things, because cotton has different qualities and all that sort of stuff. Import them into this spreadsheet, and then from that spreadsheet create graphs to look for patterns, so that we would find that, hey, if we locked in the farmers hedging in February for March, then historically we got the best price. There were some really simple things. So that's how I started. Then I finished my degree, which I did in economics. Then I went and worked for the government for a bit. Then I worked for myself doing finance for small businesses. Then in working from a home office, I discovered you could get demos of MT4. This was probably 2007. That shows you how old MT4 is, that it was around even back then, and it still only uses one core. Yeah, and then started experimenting there, and almost sort of a similar thing as TipToeHippo. Met my my business partners in my other project, asking questions on internet forums. We joined up in Skype. It's history, and just sort of have repeated again. I did that, and then sort of 2018, 2019, something like that. I just got bored and started harassing people on Reddit about their stupid ideas about 20% returns a week and stuff.
Yeah, and next question from Samus. He said, "Do we utilize rollover protection?"
Oh yes, and he sent
You sent an
an interesting that happened on Darwin X. So what happens at rollover time is all the accounts have to be done between the brokers and the liquidity providers, and then so the liquidity providers will tell the broker how much money that they've lost during that day or gained, and then all the balances between all the different companies is all sorted out. And so for a couple of minutes on rollover, liquidity providers will actually come offline so that they can run their accounts through their system and sort of get draw a line under their accounts. So what happens at that period of time, and it can be as small as sort of 5 or 10 seconds, is as the liquidity providers come offline, the spread increases. So this is the early Asian. It's like 8 a.m. in my time. So when all these liquidity providers come offline, the spread will widen. And then in the example that he gave, the spread, all the liquidity providers jumped out at a similar time, had no liquidity in the market. So the spread widened, and there's a popular thing called an Asian scalper, which takes advantage of the slow period on the graph in that point in time to make profits. And if you don't account for slippage and these spread jumps, they can seem quite successful. There was a whole heap of those traders in there looking for this Asian trading opportunity that's basically expecting the market to range. So they all were buying at this particular point, and then the spread just chunked them. They almost bought and sold these traders at the same time, and so then they had to, after buying, then they wanted to get out of the buy and sell again in a falling market as the spreads were widening, which then exasperated the problem, and it just went cluck, 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 cluck. The broker had no liquidity because none of the liquidity providers were online for that couple of minutes, and it just fucked everyone over. The good thing is that the indexes aren't open really in that period. Too late for the Yanks, they've shut. Same as the DAX. The Japanese market hasn't opened yet. So while all the liquidity providers are coming on and offline, our markets aren't open. So at the moment, we don't have to concern ourselves with that. What lots of the good brokers actually do is they'll actually turn off trading for a minute or 90 seconds around turnover, and so they won't feed in those bad prices. They'll just shut everything down, won't take any trades for 90 seconds, let the liquidity providers come offline, come back online, and then resume a normal market and avoid that spread jump that can often cause problems with people's systems.
Yeah, and next question comes from Jason. He said, how do you know a system is starting to lose its edge after it's been put into live trading?
Well, that's the $1 million question, isn't it? If you knew it was going to lose its edge before it lost its edge, then you could take it off and replace it. So you've just got to look at historical data. So if when you've developed the system over the course of time, you know that its maximum drawdown is, say, for example, 5%. Then when you put it on a forward performance on live money, if its drawdown goes above 5%, then you know that it's performing worse than it ever has in its history. And so chances are something is wrong. Maybe you stick with it, maybe you don't, but it's definitely a trigger to have a look at it. And like we said before, the default is this is fucked, it's gone, and you need to have a good reason to keep it. Before that though, you could, like we did last November, we were looking at how it was trading, and we were seeing that it was getting cut out of false breakouts, and we just said we just don't want that happening. So we decided that we didn't like its edge. So it wasn't even so much that it had lost its edge, because maybe we'd actually be at 50% now if we kept those original systems on, because it would have made more money in the comeback. But at the time, we just decided we did not like how it was losing that money and the method that it was losing it. So we reevaluated. So it's like lots of things in trading. It's an art. So while I'm always banging on about evidence and statistics and proof and all those kind of things, the way that you use the proof and the evidence and the way you look at it is an art. So the phrase or the question or the answer to is it losing its edge is not as simple as one particular thing. There's a little bit of art to it, but the most important thing is to hate losing, because if you, just by logic, when you trade, you can either win or you can lose, and your wins and your losses add up to 100%. Now, if you can minimize the amount that you lose, then your wins are gonna increase up to 1. So if you're not losing, then you're winning. And so always worry about your losses, because there's the saying, worry about the losses and the wins take care of themselves. And that's true. If you can not lose, then you'll just win. And by not lose doesn't mean not taking a loss. So in our example, our trade success might be 50%. I mean, it's a little bit higher than that, but 50%. But when we win, we make 1.5 times when we lose. So in that case, minimizing our losses is actually minimizing the size of our losses, not the frequency, but the size. So lots of times in trading, people get sort of fixated with the frequency of the losses rather than the size. And those, of course, the ultimate example of this is grid or martingale trading, where your frequency of losses is basically 0. When you group them together, you're only ever closing that group of trades as a win. And so your frequency of losses is very small. But the problem is that when that frequency of the loss comes, it costs you, the account that's going like this, it'll just go, boom, 0 gone. And so while your frequency of the loss might be very small, your size of your loss is 100%. So when you're thinking about minimizing your losses, don't get sucked into thinking that it's only the frequency of your losses. Remember that it's the size of your losses as well. And if you could even have a 30% winning system. And if you're making 4 times more when you win than when you lose, then you're going to come out in profit. So it's little things like that that you need to keep an eye out on, not just for your own development, but if you're looking at other commercial systems, how do they take their losses? Because you've got to take them. Are they a lot of small losses that match up against the same amount of wins but bigger? Or do they never take losses, in which case what happens when they do?
We're on to the final 2 pre-arranged questions. So if there's anyone in the chat that's got any more questions, just drop them in, because once we run out, we'll be finished. Next one is from Adam. He said, have you guys introduced a new payment method yet?
We accept PayPal, which most people can use. There's been a couple of people who, for whatever reason, can't get PayPal in their country. So we do have the ability now to get direct bank payment that we'll offer for yearly subscriptions. Same thing, if it doesn't work out, we'll give you a 30-day refund, no questions asked. But yeah, but if you're having problems because you can't access PayPal, give us a message and we'll see what we can do.
Yeah, and then the final question from Russian. He said, when prop firm?
Yes, well, he probably knows that I'm not the hugest fan of what is being mislabeled, I suppose you could say, as prop firms. I mean, what I would say is that if somebody has a trading record and you've got 6 months trading record, you've got the ability to show us that your system works for a long period of time before that. We've developed a really good trading copy system that can plug into PayPal and will allow you to offer your system like we offer ours. So do the maths. If you can get 100 subscribers at $100 a month, that's $10,000 revenue you could get. So if you really can trade, and it can be a demo, like I can look at a demo and I can tell if it's has a pip expectancy of 0.9%, I'm going to say that demo is not going to work live. But if your trade expectancy is 25 pips, even if it's a demo, it's valid. And we've got the ability to help commercialize your trading in like a way that is actually legit. And we won't ask you for $400 to complete a challenge. If you convince me that you're a good trader, then I'd be more than happy to recommend people use your system and can give you a method to get it out to them.
Perfect. One question I thought would be good is just the current situation with the MyFX book. We've had a couple questions about the profit factor being 0.8, which is obviously incorrect, as well as some other skewed statistics.
Yeah. There's a couple of reasons for that. One is MyFX book. I've just always had a really strange. I don't know whether the profit factor's always been strange, but Sharpe ratio has always been really hasn't been calculated particularly well by MyFX book. And then because we haven't had a consistent balance, and then the drawdown that we had last year was on quite a big balance. I think in terms of real money, we're actually still in a negative position. So that's going to just wreck all the statistics if they're just calculated on absolute values. So yeah, those statistics could be all over the shop. And we have started a new account at the start of this year with a flat balance that that we won't look to mess up by dropping in 150,000 only to take it out again and cause all sorts of mayhem with that. So yeah, it's basically because it's a live account and the balance has been up and down, while the percentage graph is measured correctly. Lots of the statistics based on real money causes a whole heap of problems with this. But nothing's perfect, and MyFX book is probably the best of all the non-perfect systems. So there's a few little quirks with MyFX book which could be good to do another video on at some point, just how to look at MT4 and the little quirks it has. Sorry, not MT4, MyFX book. But that's why it can have some strange statistics coming out.
Yeah, and what's likely to be the last?
And
go on.
Yeah, I was going to say there's a couple of questions there about robustnesses and all those kind of things, and we'll look to do these on a regular basis. So if you've got questions, throw them in the Ask Hippo channel, because that way then if there's a question that's a really good question, it could even be the topic of the whole question and answer that week. So it could be with lots of questions about robustness. We just literally pull up the white paper and read through it together, and you ask questions in the chat as we go through the white paper. That might be something that people are interested in. So jump on the Discord, go into the Ask Hippo channel, and tell us what you'd like to hear us talk about, and we'll make sure that at some point we get through to answering those questions. So
Perfect.
I think this has gone well. We'll keep doing this every week, and we might even just quickly chop up these videos into smaller bite-sized ones that then when the questions come up, they can get sort of given to people to have their questions quickly answered. So thank you for the 20 or so people that came along and watched today. It was a pleasure, and I look forward to doing it again very shortly. So talk to you all on our Discord or on the other Discords that you all know me from. So thank you very much, Dylan.
Cheers.
And we'll see everyone again soon.
How do we end this?
That's the next question, isn't it?